Let's bring in JPMorgan's Matt Boss. He's got a neutral rating, $16 price target on Levi's. And Matt, I think you like other names in retail better. Why?
Yeah, thanks for having me on, Sarah. So, look, we actually recently put out a macro and micro primer. The reality is, I think for the low to middle income consumer, 2024, I think sets up worse than 2023, particularly the front half. You're seeing savings rates for the low to middle income consumer diminish. That's the excess that they have. We now sit 500 basis points below where we did in 2019. And then secondly, the interest rate dynamic. It's not just housing, it's credit card balances. Remember, that low and middle income consumer, they carry balances, and it's a lot more costly. That's in addition, I know you've talked about student loans and some of the other headwinds that we have. So for us, you need either total addressable market that's larger, or you need trade down. That's one of the things in our survey work that we're really seeing become a much bigger theme.
It's just weird to talk about a weakening consumer on a day where we saw more than 300,000 jobs added. If the mantra has been the consumer's hanging in because jobs growth has been healthy, we still got that.
They are, but what you're seeing is a real dichotomy. So higher income consumer, I think, is holding in. Low income consumer is really pressured by these expenditures. The big five expenditures. So as you think about housing and you think about utilities, for me, I mean, this now makes up more than 300 basis points higher of their wallet than it did in 2019. So these inflationary cost pressures are really weighing. For us, trade down is one of the biggest themes in some of our recent consumer survey work that we're seeing. That would be TJ Maxx, Ross Stores, the Burlingtons of the world. I think you want to be positioned where value is king as well as convenience. The other theme that we're seeing is casual. So as it relates to athletic and active, I think that's a total addressable market that's larger. So we like the Lululemons of the world and Nike as you think about multi-year.
So, okay, total addressable market. I was going to ask you about that. You still like Macy's, though, and some of the other department stores?
Look, I think it's a tough road right now for U.S. wholesale, and I think that's what you heard last night from Levi's, and I know Chip was on Jim's show. So U.S. wholesale, the consumer slowed, and that really started in August. Inventory was a year ago caught heavy at a number of retailers, and the brands really pushed some of that inventory back and forth across the wholesale channel. I think you've now seen more of an equilibrium. So I think inventories at retail right now are very rational, and I think you're seeing more full price selling now as you move forward because of that. But you need self-help. That's kind of the point that I'm making. So you either need an idiosyncratic self-help story, or you need a customer pull given this trade down. And that's where I think the off-price retailers are taking back share, which makes it very difficult for the department stores and for specialty. I actually think it's off-pricers relative to specialty where you're seeing some of these share shifts happen. So that would be your mall-based specialty retailers, the Victoria's Secrets of the world, Bath & Body, Abercrombie, American Eagle. I think that's really where these single retailers on the specialty side are really battling now up against some of the more value retailers out there.